All right, guys, two big companies reporting right now, Microsoft, Google, a tale of two companies. I'm going to show you why. Both of them beat on revenue and profit, but Microsoft's currently down 2.5% after hours and just reported minutes ago, and Google's up 4%. This world is a wacky world. Mo, can you tell everybody what they reported versus what was expected?
Sure, this is Microsoft. So expectation was $55.49 billion.
Yep.
Came in at 56.2.
Way to go, Microsoft.
Yep. Earnings per share, $2.55, came in at $2.69.
Okay, what about Google? What about the Googly Moogly?
Google, revenue, $72.85 billion expectation. They came in at $74.6 billion. Pretty big beat. Google, earnings per share, $1.34 versus $1.44. So beat there too.
Okay. Again, Google's now up 4.25, Microsoft's down 2.2%. Even though they both beat, you might say guidance, but it literally came out at 4:02 or 4:03 p.m., minutes after the close, so I don't think they had time to guide.
Right. So you don't really need a guide anymore. All you need to do is say AI, and you'll be fine.
That's what Evan on Stock. Anyways, guys, as a channel, if you're new to the channel and you're just seeing us for the first time, we like going over quarterly results, but we don't fixate on it. Every quarter is going to be different for every company. We don't need them to beat every time. We just want to sit there and look at the company and make sure that the uptrend and the thesis is still in place. What I mean by that is, look at your life. Every single month is not the best month of your life. It can't be that way. The point is there an uptrend? And of course, the news will be out there saying, well, this is wrong, and this is wrong, and this is great, and this is great. At the end of the day, usually things are probably not as good as they seem on the stocks, and things aren't usually as bad as they seem. But that's what we're trying to teach here, is a process. In full disclosure, I have no shares of Microsoft or Google. And even if I did, it doesn't mean go buy. And just because I don't own it doesn't mean that you should avoid it. There are different paths for everybody's investment. What we're trying to do is teach a process. So Mo, which one do you want to go over first? Microsoft?
Let's go over Microsoft
Because we're going to go over the press release right now. Mo's pulling it up on the specific press release that Microsoft just gave. Go ahead, Mo.
So year over year here, revenue was $56.2 billion. That was an increase of 10%.
In constant currency.
Operating income increased 18%. Net income increased 20%. Holy moly. These are some big numbers here.
EPS increased 21%.
Yep.
This is sounding like a company that's a $5 billion company that's crushing it.
Yes. Let's see if there's any other big highlights in
Well,
here.
remember one thing. They announced that new Microsoft business thing that's going to be $30 a month. Mm-hmm. I don't know exactly what that is. It's going to be optional for every business, but it's something to consider out there because they have a lot of users, and $30 per month per user can add up pretty freaking quick.
Commercial products and cloud service revenue increased 12%.
Wow, I would have thought much higher.
Yeah, me too.
Interesting.
LinkedIn increased 5%.
LinkedIn, baby.
Let's see. I want to see if is there anything about AI in here that
I can just Control F AI.
All right, let's see.
But it's going to be like some words that start with AI. Or that, there you go. First,
organization. Okay.
We're asking only how, not only how, but how fast they can apply this next generation AI to address the biggest opportunities and challenges they face.
We remain focused on leading the new AI platform shift. Okay. Let's see what else there is. Xbox content and services revenue increased 5%. That's going to be interesting because they're working on this deal with Activision Blizzard. Not done yet, but I can't wait to see what happens.
So they did a deal with Sony to license Call of Duty for the next 10 years.
Oh, so there was an end date.
I thought there was like a 10-year deal. Let's look it up. Let's look it up right here because this is what we do on this channel.
Yeah. Not saying that you're right or wrong. I just didn't.
Microsoft,
I didn't see if there was an end date.
Sony, Call of Duty deal.
Now I know they got an extension on the deal.
Yeah, Sony agrees to a 10-year Call of Duty deal with Microsoft on July 16th to keep the franchise on the PlayStation platform. Now Microsoft's only down 1.23%, and Google's up 4.5%. All right, so guys, what we do on this channel is we're trying to sit there now and look at these. Okay, actually, let's go to the earnings, the quarterly earnings for Google, also known as Alphabet.
Okay.
By the way, somebody was trying to complain. Somebody on Twitter yesterday was trying to say that everybody accepted Alphabet really quick. They'll accept X very quickly for Twitter, and I was like,
it's actually a pretty valid point.
No, it's not, because you still go to google.com and you still say Google. You don't say Alphabet it.
Outside of me having to go to abc.xyz for every earnings call and I get really confused,
And you don't go to alphabet.com to go to Google. You still go to google.com.
You're right.
All right, go ahead. This is Google.
Google, year over year. Yeah, revenues. Revenues increased 7%. Let's see here. Operating increased 29% over the previous year. Let me scroll down here. Okay. Google. Wow, look at these numbers. Google search and other. 42.6 billion. YouTube ads, 7.6 billion.
Okay, it's back up.
Yeah, it is back up.
Google Network is down.
Oh, yes, this is down. So this is 2022 here, 2023 over here.
Interesting.
What about the cloud? Oh, the cloud is up pretty big.
Oh, yeah, that's big time up, almost 30%.
Let's see if here's services.
That's net. Is that net income? Yeah, operating income.
Yep.
So the cloud just went to profitability.
Yep.
Wow.
Yep.
Other bets. Oh, wait, they can go back to other bets. Other bets, guys, that's a $500 million swing. Other bets are there other things that they're investing in to go for the future, which I love.
All right, let's see. Reductions in workforce. In 2023, we announced reduction in workforce. That's really no surprise, but we haven't really heard a lot about a lot of these tech companies cutting jobs anymore as we were in the beginning of the year.
Yeah, I think I read something like it was 220,000 tech workers around the world have been laid off already. And by the way, speaking of Microsoft, go back to Microsoft real quick. You don't have to go to the sheet. They just passed $1 billion in compensation for their CEO. Just passed it like last week. His total compensation has exceeded over $1 billion. Wow. Which a lot of people complain about, but Jaylen Brown just signed a $304 million contract, 5 years for the Boston Celtics. There's more basketball players making over $30 million a year than there are CEOs of Fortune 500 companies making over $30 million a year. Did you hear that, Tim?
And I don't hear anybody complaining about them.
There's still people complain.
Well, not as much as the rich damn CEOs.
Yeah.
Screw those people who employ people.
Yeah, exactly. All right, so Microsoft. A couple of things. Low debt company, high PE, guys. A 5-year PE of 47, a 1-year PE of 38, a very paltry dividend of 0.7%, but it eats up about a third of their cash flow. Very high return on invested capital. These guys are great about getting a return on the money that is invested in the business. So as they are getting cash flow, they have the opportunity here to reinvest potentially at high rates of return. The question is, can they?
Yeah.
The cloud with Microsoft and Google offers a lot of opportunity for them to reinvest. But even then, how much can they possibly do?
Right.
Can Google find another YouTube business?
We were just talking about that in the car today.
How great that YouTube business is.
It's amazing.
Yeah. Amazing.
Really, we were talking about how it's changed people's lives and how we get to do what we would be doing anyways, but we're on YouTube doing it. And it's incredible.
Do you know what's amazing to me? The gross profit at Microsoft is 68%, which means for every extra unit they sell, 68% basically goes to pay overhead and taxes. What do you think Google's is?
50?
55. I would have thought way higher than Microsoft.
Wow. Me too, because it's all...
Yeah, it's all ads. I mean, Microsoft has so many employees. I mean, Google has a lot of employees, don't get me wrong, but I would have definitely thought it would have been way more than Microsoft.
And Microsoft has a lot of hardware. They have the Surface, they have the Xbox.
Yeah, that's true.
Google doesn't really have those. They have their Google Home and I don't know.
Yeah, that's true. I didn't think about that. All right. So let's look at the 8 pillars for Microsoft. Right. What do you think it's going to look like? Probably pretty similar.
I think it's going to be everything except for our 2 valuation metrics.
And my good friend Mo is quite spot on. Guys, remember, if you have our software, you can customize your pillars up to 12 pillars. I think there's like 4 quadrillion different variations. Here are 8 pillars: high return on invested capital, buying back shares, which I don't like, guys. I don't want a company to buy back expensive shares. If you're new to this channel, watching this video for the first time, everybody promotes buying back shares except for us. We want to buy back cheap shares. We want to buy back cheap shares. That dividend is also useless. Why are they paying a 0.7% dividend? I just don't get that. I don't understand that whatsoever. Cash flow growth, huge. Net income growth, huge. Revenue growth, huge. Very low debt. They can pay back all of their long-term liabilities with just 2 years of their 5 years, their average of their 5 years free cash flow. And like Mo said, 5-year price to free cash flow is 52. 5-year PE is 47. So guys, it seems expensive, but remember, it's a great moat. It has a high return on invested capital, which means as they reinvest in the business, they can generate higher profit much faster. And did I mention it's a moat? I mean, who's competing with, like Google Drive? I don't even use Google Drive anymore.
In comparison, it's terrible.
Oh, terrible. Terrible compared to Microsoft Office, in my opinion.
When you're using something super basic, if you want a Word document to share live, that's why you use Google Drive.
Absolutely. Now, what are analysts saying, Mo? about Microsoft.
One thing I do want to point out about the share buybacks, they've been buying back shares consistently for the past 20 years.
Barf.
Yeah, just every year, no matter what.
Barf.
All right, analysts.
Analysts believe this year ended at 90. So this was the last quarter. This is the last year too.
Yeah.
Can you find out how much they actually ended up making this year? So while I look at this, they're expected to make 98.7 in the year ending a few weeks ago, and 21.48 according to analysts in 4 or 5 years. 1, 2, 3, 5 years, which is over double the net income. And that has to do with the high return on invested capital and that high gross margin. As they really drive more and more revenue in with a high gross margin and a high return, they can generate a lot of profit. The fact that it's such a company that's $2 trillion can double their profit potentially in 5 years, that is incredible. I love it. Revenue growth, still double digits. They're expected to do $380 billion in revenue in 2028. Anything there? Well, you probably have you know what we have?
What's that?
I'm a dingus. What was their earnings per share this quarter?
They did 269.
269. Ready?
269.
So they did our last 3 quarters was 246 plus 220 plus 235 plus 269. They made $9.70. And the expectation, according to analysts, was 987. Okay. So they were a little bit lower.
Yeah.
All right. 52 analysts. All righty then. Should we go to Google first and look at them, or should we do the stock analyzer tool first for Microsoft? What would you like to do?
Tim is making a decision on the fly here.
Which one?
Let's do stock analyzer.
All right.
We'll do stock analyzer first.
All right, guys. So as you know, Stock Analyzer tool, amazing software, has been used well over 2 million times since we premiered it. It's wonderful. It focuses on growth, margins. It does not include the balance sheet, and it allows you to make your assumptions about the future. This tool, along with all of our amazing tools here, this is your one-stop shop for investing. All of your investing needs in one app. That's it. Everything you need for investing is in one app. You can make great decisions, learn a lot, be involved in a huge community to be able to talk to thousands of people. It's all available right now, everythingmoney.com. We're running a special right now, $29 a month versus the normal price of $39 a month. Sign up now, everythingmoney.com. You get all of our tools here, including the Stock Analyzer tool and our community, everything on your app, your computer, all in one spot, over 10,000 stocks. All right, so Mo.
Yes.
Give me some revenue growth numbers for Microsoft for the next 10 years.
Oh, 6, 9, and 12.
That coup. I like that. And here's why, guys. The analysts are expecting double digit. I think Microsoft should be able to grow at 6%. The only thing I might have done differently is maybe 5, 8, 11, but I think 6, 9, and 12 is great. What about profit margin? And as we see here, profit margin here has been increasing.
Yeah.
So in the last 10 years, it's averaged 28.8%, but in the last 5 years, 33.9%. So is that profit margin to stay at this level? Go back? Go higher? Where's it going to go?
I would guess higher.
Okay.
Right? How about 32, 34, and 36?
That's more aggressive than I would have done, but that's fine.
What would you have done?
I would have done 30, 33, and 36.
All right.
Okay, what about free cash flow?
Let's see here. 28, 30, and 32?
Okay. And PE. Now remember, guys, when you're putting your PE numbers in here, even though we have it here, don't make your PE, oh, by the way, look at Microsoft, it's even now. Don't make your PE based on this PE. What I would do is start with the market average of 15. And if the company has a big moat, has revenue potential, and has a high return on invested capital, which, by the way, the high return on invested capital is indicative of a moat. Because a company that has a moat has the protection of brand and pricing ability, they're going to be able to get high returns on the money that they invest in their business. So that's an indication of a moat. And guys, if you're new to investing, that's some more complicated things. We have, as you saw, some more basic things about the company, but please subscribe to the channel, listen to us, because you're going to learn a lot about investing and learning this process. So, Mo, start at 15 in terms of your head. Where would you start the lowest PE multiple for 10 years from now?
I'm thinking 16, 18, and 20.
Okay.
And 20 may seem high for almost $3 trillion,
2.6
trillion. But
I actually think you could have gone higher than 20.
I think so too. They're.
I could have gone to me, I could have gone 17, 19, 21, or 17, 20, and 23.
And if they can do 12% revenue, that's incredible. With
That's
36% margins,
yeah. So I did the same thing for price of free cash flow because we want them over long periods of time to be about the same.
Right.
Now, final input. What is your desired return, Mo?
I think 10, 12, and 14%.
Now, here's the thing, guys. You can get 9 or 10% by investing in a long-term ETF, but we kind of beat up Microsoft here. So it's okay if we get a 10% return. To me, I look at it going, if I can buy Microsoft and they don't do very well and I can still make 10%, I'd be happy. I'd be like, great. And by the way, remember, these all include the dividends, because this is all cash flow coming to the business and dividends are paid out of cash flow. So all we're counting is all the cash flow in the business. If you own the business 100%, and this is the way you're going to sell it in the future, this would be your return. And that's what you're buying when you buy a stock. You are buying a piece of a business. You're buying a future stream of cash flow. And your return is going to be based on the price you pay for that cash flow. So I'm going to do the stock. Stay with me for Google next. When we do stock analyzer tool for Google and go through the whole thing. But listen to the numbers that come out here, because it's very, very important you understand what we're doing here. Hit the analyze button. Oh boy. Low price, 145 to 165. High price, 220 to 250. Middle price around 200. It's at 345 right now. Just hit the positive territory, guys. I have it on 190, which is right in the middle of this. I might increase it a little bit here. I actually think that I'm going to increase
increasing mine.
I'm going to increase mine now. And this is what I mean, guys. When I first started this channel, I was buying Microsoft I wanted to buy it like 140, 150. And as they've done better, and as their assumptions have gotten better, I've increased my value for the company. So naturally, the price I want to pay goes up. Now, this current price return here, if you paid today's price of 346 and they performed on the low level, you would lose about 1% a year. If you bought it at today's price and they performed the middle level, you'd make about 3.5%. And on the high level, you'd make about 8%. So this tells me you have to really, really expect high results to even be able to get 8% return here. Is it worth it to you? You might sit there and say, Paul, you're an idiot. They're going to grow up 15% a year for the rest of the time. Hey, your money, do whatever you want with. My goal is to find the few stocks that make the most sense and put big positions in them.
Right.
All right, let's go to the googly moogly.
Google's up 6.5% right now.
Oh my gosh. 6.25% now. It is up year to date 37%, Mosafine.
Sounds normal.
Look at this, guys. $1.57 trillion market cap. That means all the shares, if you bought them all outstanding, $1.57 trillion. Their enterprise value is 1.56. It's very rare that the enterprise value is lower. That means there's basically no debt in the company. They could pay off all their debt with writing a check. That's an incredible feat. Another PE. Okay, 1 year PE is 27. 5-year PE is 32, lower than Microsoft's. And there's been a lot of negative news about Google in the last year or so. That's why it hit a low of $83.45 back in November. This is the day before Facebook's low, by the way. It's currently at 130.
So it's funny. You look. I'm looking at quarterly here, and on the revenue. If you go to the income statement, you go quarterly. Over the last quarter, revenue's actually gotten worse. Now net income has gone up, but I look at this saying, man, this thing was at what was the low, $80 or something,
yeah.
And it's up to 130 right now, and things have somewhat gotten worse for the company. I mean, they've gotten better in a lot of aspects, don't get me wrong, but that's just the irrationality of price movements.
Oh, absolutely. That's what we want to teach people. We want to teach people that the stock price movement is going to be completely irrational. There's no way that this company is really worth 6% more because they reported 1 quarter of good earnings. And by the way, I just got a message from someone. The CFO of Google is going to become the president.
Ooh.
Yeah. His name is Porat. He's becoming president. That was just announced. I don't know if it matters or much, but that's what it is. Okay. 5-year oh, look at this, Mo. The last 1 year free cash flow is $62 billion. The last 5 years of $47 billion. Is that a lot of cash flow?
That is a lot of cash flow.
That is a cash flow problem, just like Microsoft and Apple have. They have too much cash flow. What do you do with that money? Well, if this company was a lot cheaper, you'd buy back the shares.
Let's see if they were doing that when they got cheap. They were.
Of course they were.
But they were also doing it forever. Every quarter they buy back shares.
Mo, what do you think the 8 pillars look like?
I think it's exactly the same as...
And it is.
Microsoft.
Our 2 value metrics are X's. Again, doesn't mean it's expensive. If Google and Microsoft are going to grow 100% a year, those are very, very cheap metrics in which to buy from. It's just all about how you're going to make assumptions about the future, which is very key here. But they have everything else as a check. You know what I like here, Mo?
What's that?
Different from Microsoft, their cash flow growth is higher than their net income growth. Yeah. $36 billion in the last 5 years increase in free cash flow, $30 billion in net income. Microsoft was flipped. Boy, $142 billion more in revenue.
I know.
The ROIC is not as high as Microsoft's. Microsoft had 25% over the last 5 years. Google's 14.5%. But look at this debt number. They can write a check for that debt in half a second.
I wonder why they have the debt.
Somebody has to feel important.
That's true.
I don't know.
CFO has
that CFO they just promoted to.
That's why, because they had debt. He knew how to manage it.
Okay. Analyst estimates. They're expected to make $5.50 this year and grow to $9.68 in the next 4 years. Revenue of $310 this year is expected, growing to $441. So mid double digits, mid-teens growth on EPS, earnings per share, and high single digits on revenue.
Yeah.
It's a big company. But I do think that a company like Microsoft and Google, both companies, will grow as the world becomes more and more technologically advanced.
Think about all the ads that they can just start giving to Africa and parts of China.
How many people are going to start buying Microsoft Office?
I know. Yeah.
Absolutely.
Yeah.
You know, I just saw a picture of Kenya recently, and there was a big Oracle building right in the middle of Kenya. Mm-hmm. You know what I mean? I'm like, okay, there we go. Yep. They'd have to be Africa's the next frontier. I always say because Alaska's the final frontier. Yeah. Isn't that what it is? Alaska's the final frontier?
I think so.
Okay, so Africa's the next frontier. And I think that's going to be a lot of growth potential for them. So let's go stock analyzer tool. Again, guys, stay with me the entire video. I want you to understand how we look at these companies, how we verbalize this. So we're doing a 10-year analysis just like Microsoft. But again, you can do up to 20. Mo, give me your revenue growth numbers, low, middle, and high.
How about 6, 8, and 10?
6, 8, and 10.
And I think that all of those are perfectly reasonable numbers.
Okay. And the last 10 years was 20% growth. Probably not very likely as they get bigger and bigger to do that again. That's amazing growth numbers, isn't it? Well, that's probably because of YouTube and all the world of whatever.
Right.
All right, profit margin.
Why don't we go 20? Maybe 19? 19.
Where are you getting 19 from?
Because in the last year they did 20.
Okay.
So why don't we just start really low?
Because it was 1 year of 20.
I know, but let's just start really low.
Okay.
You don't think?
Let's go 19.
19. Let's go 22 and 25. Let's see. You don't like it?
No, I hate it.
Really?
I think you're beating up.
What would you put in?
I'd be putting it at 21, 23, 25.
Okay, put that in.
No, let's keep 19, 20.
Okay,
let's have this. Let's do 20. Let's do 20, 22 and a half, and 25. Okay. I heard that, Tim.
I did too.
Scam.
Okay.
Okay, what about free cash flow?
Put it the same numbers.
Now, guys, these are the conversations that we have. This is not a science. This is an art. Yes, the end of it is math, but you've got to make the decisions on the future. The point is, you shouldn't be buying a company where you have to manipulate the numbers here and there to get the number you want. Mm-hmm. It should be like, okay, this is obvious. So we'll see. When Google hit $83 on November 3rd, we're going to see what these prices come out at, like how obvious that price may have been. I don't know if it was obvious, but let's go see. Free cash flow margin, same thing. What about PE and price to free cash flow at the end of this 10-year period?
I think Google's more of a moat than Microsoft.
Okay.
So 17, 19, and 21.
Sure. Same thing for the free cash flow. And desired return, Mo?
I would put in the same desired return.
10, 12, and 14. Guys, hit the analyze button. Remember, listen to me here. Listen good. Look how obvious this price looked at $83. 85 is our low. 123 is our high. 103 in the middle. If you buy at the low price, at current price, and the low results occur 5.2. Middle results occur 9.7. Highest results occur 14%. I have in my watch list at 100. Keep in mind, guys, I had on my watch list at 80 about a year ago. That's why I never got any. So there you go. Thanks very much. Appreciate it. And guys, again, everythingmoney.com, $29 is our special today at $10 off per month. Sign up for it now. $1 a day gets you everything you need for the finance world on your phone and your computer. Thank you very much.